Hey guys, in this video, I want to show you how to value stocks using bond math. Now, the use case for this is that you have some savings that you want to invest to make your money work for you while you sleep. And the problem is you don't have a framework to compare all the different options that you have. For example, you could open a high yield savings account and earn, you know, maybe 3 to 5% per year. Okay, 5% as of September 2025. Um, you might have some friends that are doing real estate investments. You have some friends that are maybe looking at stocks, or maybe even bonds. But you don't have a framework how to compare which one will be the most productive and efficient use of your capital, of your money, right? So that's the framework that I want to walk you through today. Um, and so let me take a step back here. Um, and there's a scene from the movie Moneyball that explains this mindset shift you're going to have to create for yourself really well. And it's the scene where Peter Brant and Billy Bean are in the garage, and it's just after Cleveland had rejected all the proposals that Billy Bean makes, because Peter Brand was advising the team, and Billy Bean realizes this guy might know something that he doesn't, and so he gets him to kind of talk to him in the garage. And Peter Brand says something really interesting, right? He says people who run ball clubs think in terms of buying players. Your goal shouldn't be to buy players, your goal should be to buy wins. And in order to buy wins, you need to buy runs. And investing is very similar. The goal is not to buy stocks or bonds or real estate or even businesses. The goal is to buy future cash flows at a cheap price. But you need a framework to determine whether you're buying something at a cheap price. And the framework for that is annual returns, estimated annual returns that you are forecasting that you'll earn based on what investment that you're making, right? So um, a clean way to look at this is in Excel, right? And kind of lay out your alternatives. So you have a high yield savings account, um, and you can expect as of September 2025, we'll just go off of what Google's AI was saying of 5%. Um, and why is this cooperating? 5%. There we go, 5.0. Okay, so that's one option. Um, and another option might be real estate. Another one might be stocks, bonds, um, or like a private business, right? Private business opportunity. Uh, and uh, the reason this framework that I'm about to show you, annual returns, matters is because it underpins the entire investing landscape, and it's a foundation to evaluate any investing opportunity. And the best way to talk about it is to just run through the math in various examples, right? So let's say that you want to buy a house, right? So we'll make a few different sections here. Um, so so let's just say we'll just call it real estate. Okay, so and we're gonna simplify this. The real world is far more complex, and there's all sorts of different ways you can structure deals. But we're gonna keep it nice and simple, just so you get the framework, and then you can slot in the complexity um, as you kind of encounter more and more real world situations, right? So the main thing for a house is just your purchase price, net of all the, not net, but actually adding all the fees to the agent and the inspector and all this stuff, right? So we're just going to include all of that in purchase price. So let's say you buy a house for $250,000, okay? Um, and we will color this blue because it's an assumption. And okay, and then we'll clear this, right? Um, and for now, let's assume that you don't collect any rent, okay? I know it's a silly assumption, but just we'll add the rent in later on, right? And then let's say the exit price or the sale price um, is $500,000, right? 500K. And let's say your holding period was 10 years, okay? Same frameworks. Number one. Cool. All right. So uh, every investment we can break up into the cash yield, meaning the yield that you generate while you're hold on to the investment, whether it's a bond, real estate, stocks, or whatever, and then the capital appreciation from um, the difference in terms of what you paid and what you sell it for, right? Like most people just think about, okay, I buy a stock at 5, I sell it at 10, I double my money. That's my capital appreciation. But you can also get a dividend, right, in a stock. And it's the same deal with a house, with businesses, and also with bonds, right? The math is going to be very, very similar. And then this is going to add up to the total returns, okay? So the cash yield, because, we'll be really specific about this, we'll call this the annual rent, okay? The cash yield, in this case, is going to be 0, but I want to set up the formula, right? So the cash yield will be the annual rent divided by the purchase price. Um, and the capital appreciation is going to be the sale price divided by the purchase price to the power of 1 over the holding period minus 1. This is kind of just like your compound average growth rate, right? Yes, you doubled your money, but it took you 10 years to do it, right? So your annual return is not going to be 100%, right? Because it took 10 years for this to happen. So your annual return is going to be 7.2%, right? Because your capital appreciation is 7.2, and then your annual return is also going to be 7.2% because there is no yield in this particular example, right? Um, Now let's say that you collect $25,000 in rent um, per year, right? So then, per month, this would be like 2,100 bucks roughly. So now you have a 10% yield, and then your capital appreciation is 7.2%. And so you get a 17.2% rate of return, right? And now you can compare this to the 5% return. Now, it's not just about the return, but it's also the risk reward, right? Your high yield savings account, it's very low risk. But in real estate, you're taking some risk. There could be a real estate crash, there could be, a new housing development that, a giant neighborhood kind of opens up next street, that a bunch of supply floods the market, and suddenly, your sale price is like 300K instead of 250, and your rent gets um, cut in half, right? So there's a lot more uncertainty, but um, this is kind of how you set up the math, right? And it also helps you very quickly evaluate investments. You don't have to jump into Excel every time, right? If someone gives you the rough numbers, you can kind of calculate it in your head, right? Okay, rent 25K on 250, that's 10%. And then, I'm going to double my money over 10 years. Um, and you can use what's called the rule of 70. 72, I think, where you take 70 divided by the number of years it takes to double um, the money, and that gets you a rough estimate of the annual return over that time, right? So it's 7% in this case because it double over 10 years. I'm just using simple numbers here. But this is basically you don't have to really value stocks. You really just have to calculate the annual returns, right? Um, and it's going to be the same deal with bonds, right? Um, and so for this exercise, I'll give you the inputs, and then you try to go out and do the calculation on your own. Pause the video, and then you come back, and we'll compare what you did versus what I did. So let's say for the bond, the face value is $1,000. Okay, and let's say it's trading at a price of 100, just to keep the math nice and simple for now. And let's say the interest rate or the coupon is 10%. Okay. Percent. And let's say the time to maturity is 5 years. 5 years. Okay. So basically, what this means is you're going to lend someone through the securities markets $1,000. They're going to pay you 10% interest every year for 5 years. And then 5 years from the date that you gave the money, you're going to get your principal back, the $1,000, right? So it's going to be the same thing, right? It's just that the terms you see are different, right? The rent versus the interest rate, um, and the purchase price versus the just the price of the bond, and the time to maturity instead of the holding period. But the concepts are the same, right? It's going to come down to a cash yield and a capital appreciation. So go ahead and pause the video and crack open Excel and try to do this math on your own so that you're applying these concepts. And then at the end of the video, we'll actually do this for Philip Morris stock. And so you'll have like a real world example, not just these made up ones. But let's start with the simplified made up ones. Okay, so hopefully you went out and did the math. So the cash yield is going to be um, the face value times the interest rate, right? This is going to give you the $100 of um, interest payments you're going to collect every year. And then you're going to divide that by um, the face value times the price divided by 100. Okay. Um, and you'll see, because you could have just done like 10% for the cash yield. You'll see later on why it's important to set it up this way, because in the next example, I'm going to change the price, and then you want your cash yield to change automatically without you having to have to go and redo all the formulas. Okay. So 10%, right? The capital appreciation is going to be um, uh, okay. So actually, we'll set this up a little bit more in a more straightforward way. So we got to do the buying price and the selling price. Okay. Insert row. Okay. So let's say it's nice and simple math, right? You got it. You paid 100 for it, and then you're going to sell it for 100. And what this price really refers to, I'm sorry, I should have explained this earlier on if you're not familiar with bonds. it's basically referring to whether you're getting a discount where you're either paying more than the face value when you buy the bond or you're paying less. Okay. So whatever the buying price is, if you take that and divide by 100, this is the percentage of this face value that you're paying when you buy the bond. And this is going to be the same, right? The percentage of the face value that you pay when you sell the bond, right? So if the bond's trading at 92, then you're going to pay 92% of the face value in order to get the face value at maturity. And if the bond is trading at 120, you're going to pay 120% of the face value when you buy it in order to get the face value 1,000 at maturity, right? Um, so we are in this. And so the capital appreciation is just going to be very similar to the capital appreciation before, right? So the sale price over the buying price to the power of 1 over time to maturity minus 1, right? And because in this case, the buying price and the sale price, the selling price are the same, there's no capital appreciation, right? And so you get 10%, right? So your total returns, which is also referred to as yield to maturity, um, uh, maturity, yeah, is the same as your um, interest rate, right? Like your coupon rate, right? We can even change it to that, right? Just to kind of get more familiar with the lingo. Okay, so now, um, I will before I actually enter it, because the values will change automatically. Um, do the math if you change the buying price to 50 instead of 100, right? So now you're getting the bond at a discount, right? So what will this mean is like, there's a company that issued bonds at par, which means at 100. And a couple of years in, the company runs into financial trouble, and investors don't think they're going to get their money back, right? And so the bond trades off to 50 cents on the dollar, right? And so now, as a new buyer at 50 cents, you're getting to pay 500 now in order to receive 1,000 at maturity, right? Um, for every increment of the face value that you buy, right? And so that's going to change your cash yield and your capital appreciation, right? So we're going to assume that you're going to get par, like the face value at maturity, but we're also going to assume that you're going to pay 50 cents of the dollar, right? So go ahead and pause the video and do that math and come back. Okay, so now let's see what happens, right? So you pay 50. Now your cash yield went from 10 to 20, right? Because now the company's still going to be obligated to pay the $100 of coupon, right? Which is the 1,000 times 10%, but you only paid 500 for it, right? So now it's going to be what's happening in this formula is the 100 is being divided by the 500. And so your current yield, like what you're getting paid to wait, basically doubles to 20%, right? And then now you're also getting a nice capital appreciation, right? Uh, you're doubling your money in 5 years, right? And so you're getting like a roughly 15% return from the capital appreciation as well. So now your total yield to maturity, your total returns, comes out to 35%, right? Um, so now let's do an example with stocks. Okay. So again, the terminology is going to be different, but the underlying mental model, the framework of returns, are going to be the same, right? So let's say, uh, and you'll see I'm not just using earnings per share, but I'm using economic earnings per share because a lot of times what the company reports as earnings per share, you got to make a bunch of adjustments to it because there's a one-time loss, or there's like some kind of um, uh, you know amortization from like purchase accounting for an acquisition they made or something, right? And these are all concepts we'll get into later, but it's very important to use economic earnings per share. And there's no like hardcore definition for that. That's something you have to kind of determine by reading through the financial statements, understanding the business, listen to what management has to say. But let's say it generates $5 a share, okay, in earnings per share, um, our made up stock. Okay, and let's say it trades at uh, 25 times earnings. Okay, so this is the price to earnings multiple, um, which would mean the stock price is just the EPS times the PE. So you're paying $125 a share um, for this stock. Okay, there we go. Okay, um, and we'll call this the entry P. Okay, um, and so now let's say that the company reinvestment rate. So this is like what percentage of the earnings the company puts back into the business. Okay, in order for the business to grow, new product lines, building out more stores, whatever the kind of use of capital is for the business to grow the business. And let's say the business has a 25% reinvestment rate. This will be a hard code, blue, percentage, decimal. Okay, so uh, now we'll call this the distribution rate. And that's just going to be one minus this, right? So the company takes uh, whatever earnings it generates, right, the $5 per share times the number of shares outstanding, and it reinvests a quarter of it back into the business, and then it pays it out 75% to investors. So that means you're actually we'll set up the dividend yield later on. But let's say the business continues to pay you a dividend, um, and it reinvests in the business and it continues to grow at a certain rate. Um, and in 5 years, you let's see, five. Okay. Let's say the price to earnings multiple, because the business is continuing to grow, it compresses because there's not as much growth left in the company 5 years from now, right? This is an assumption you're making, right? Hey, I'm buying this company at today, $125 a share, $5 a share of earnings at 25 times. I think you do all the work about the company and the management, and you make the determination that in 5 years the company will trade down to a 15 times multiple. Okay, um, 15 times. Okay. Now the question is, okay, like how do I calculate the returns, right? So um, I have given you enough information to calculate the returns, but there's a curveball here, right? Because it's the financial security that now we've now gone from bonds to stocks, it works a little bit differently, right? There's a dividend yield that you're going to have to calculate. There's like this entry and exit PE. So go ahead and pause the video and try to, estimate the returns on your own and take however much time you need, pause the video and come back and we'll go through the example. Okay, so hopefully you've done the calculation. So um, with stocks, the curveball is this. It's not just the cash yield and the capital appreciation. You can actually break it up into three categories, which is the cash yield, the growth, and the change in multiple. Um, so that you can really kind of break up um, the drivers of the returns into those three components, right? The yield, the dividend yield you're getting, the growth in your dividend yield, and the change in the multiple, right? Those are three very different bets, right? The reason we break it up into those three things is if someone's betting that the multiple is going to go from 10 times to 20 times and there's no yield and no growth, that is a very different type of bet, right? You're basically betting that other people will pay you more for the shares in a handful of years, and that's very different from saying no, actually the company, I don't care what the multiple can even compress in half, but I'm actually betting that the company will grow, right? So it shows you the risk reward profile of an investment by breaking up the returns into those three components, right? So your dividend yield is going to be um, so your dividend will be, let's see, the $5 of earnings per share times the distribution rate divided by the stock price, right? You see there, it's like it should feel very similar to you for calculating the cash yield up here and also up here, right? With the real estate and the bonds example. So a 3% yield. And remember on the dividend yield, you're going to get, I mean, you're going to have to pay taxes on all of this, right? So we're ignoring taxes for now to kind of keep the math simple. But that is another kind of real world complexity we'll have to deal with later on. The growth. Okay. I actually didn't give you sufficient information to answer this question. I'm sorry. This was the missing piece. I apologize. Um, so you also need to know the incremental return on equity, right? So let's say the business has 25% incremental return on equity with, you know, well, actually, let's make it 30%, just so you don't get confused with the numbers. Um, so, so the business is taking 25% of its earnings and reinvesting in the business. And I'm saying that the business, not the investor, but the business is earning a 30% incremental return on every dollar that it's kind of plowing back into the business, right? Um, and so uh, your growth rate is going to be your reinvestment rate times your return on equity. Okay, so it's going to be, in this case, 7.5%. And then the last piece, change in, yeah, we'll just call it change in multiple. Oh, why don't we call it multiple one slash headwind? Right. So because we got in at 25 times and we're getting out at 15, there's a headwind, right? This is actually going to detract from our annual returns, right? But if it was the opposite, if we got in at 15 times and we exited at 25 times, it would be a tailwind, right? It would add actually to our returns. But this is going to look very similar to the capital appreciation, right? You're just going to take the exit multiple divided by the entry multiple of 1 over the holding period minus 1. Okay. So this is going to be a 10% headwind for us per annum per year. Okay. So 0.8% returns, right? This is not a very good investment if these are the things that play out, right? Another way you can kind of if you want, you can actually forecast out all the cash flows over time and see actually what cash flows you're going to get. But I don't know. I can do that in a separate video. But for this one, I just wanted to introduce you to this framework of total returns. Um, and so if you take the the exit PE and you assume like, okay, it continues to trade 25 times in 5 years, now you no longer have this 10% headwind, right? And you have a 10% rate of return, right? Um, and if um, uh, we change the reinvestment rate to 50% um, and the incremental ROE to 45, right? This juices your returns, right? Um, and so hopefully this gave you a nice framework of how to think about um, using this is really kind of at its core bond math, but you can use it for real estate and for stocks. It's just a quick and dirty way to compare. Instead of just being like, oh, this company is too expensive because it trades at 90 times PE, you can actually go in and do the math and see what are actually the returns, right? Because again, like you're not trying to buy multiples or stocks, right? You're trying to generate returns on your capital, right? Again, the same as, and you're trying to compare it to different options that you have to generate money while you sleep, right? That's the entire goal. And so, why not actually use returns, which is the ultimate goal, to actually evaluate your um, investment opportunity instead of using like multiples or being like, okay, yeah, this is like a good, real estate play or whatever, right? This is the framework you can use to actually evaluate. Okay, so now let's do a real world example, right? And we can use just the same thing I have here, and let's use Philip Morris for our example. Okay. So again, I'm going to make a ton of assumptions here, and this is not actually what I'm saying is going to happen, right? Uh, all right. So we have um, here. There we go. Increases. Oh, this is just a dividend press release. All right. Okay. So this is. Um, and by the way, if you're not familiar, this is a website that shows you all the filings that publicly traded companies in the United States file. And so this is where you can get kind of primary, like, well, technically not primary, but information straight from the company instead of going through an intermediary. But, if you're more comfortable with Yahoo Finance, you can totally do that. But you see, this just gives you a lot more information and context about the company than just simply going to Yahoo Finance, right? And it's good to kind of get used to looking at this stuff. So um, the adjusted diluted EPS minus currency impact for the quarter was $1.89. So I'm just going to assume that we're just going to multiply that by 4 and ignore seasonality and all this stuff, right? It's just a simple assumption. Um, And so I don't want to screw up the formulas here. So we'll keep whatever's hard coded as hard coded. So the share price is $165. 165 divided by this. Um, and then the reinvestment rate, they're paying, they said, they're going to increase. Oh, no, actually, why don't we just run with whatever they reported in this one? Okay, cool. $5.40 a share. This, it'll actually be one minus. Okay, so they're only reinvesting like, 30% roughly of the earnings back into the business. And okay, the incremental ROE is going to be a little bit tricky. So we're going to have to make again, another assumption here. And look at their balance sheet. Where's the balance sheet? Okay, it's not in the press release, so we'll have to go to the quarterly filing. And there we go. This is what we want. Okay, financial statements. Okay, so the way we're going to calculate this incremental ROE is we're going to look at the change in the net earnings. So 3148 minus 2528. And again, there's a lot more work that goes into actually doing this properly. I'm just setting up the math so that you start to familiarize yourself with this concept, right? Um, this concept of incremental return on equity, this takes a long time to figure out, what the going forward rate is going to be. You have to analyze a business, see whether it can defend itself against competition, the economics of the business, how revenue flows to earnings. Um, um, and yeah, there's a lot more work. And we're also making another assumption, which is that we're ignoring share buybacks. Uh, that's another kind of layer of complexity in the real world. But yeah, again, I want to start off simple, and then we'll build the complexity over time. So you look at for the incremental return on equity, you can look at the change in earnings and divide by the change in the book equity. Okay, and in this case, the change in book equity is going to be a little bit tricky because um, Philip Morris is such a phenomenal business that it has returned more capital to its shareholders cumulatively than what was cumulatively put into the business, right? So you often see this in really great businesses or in companies that are on the verge of bankruptcy. They'll have a negative book equity, right? So we're not going to be able to actually calculate based on actual numbers, right? So let's just make an assumption that the incremental return on equity, Philip Morris is an incredible business, and um, let's say it's like 30%. Okay. Um, and so right now your entry PE is 20 times. So let's just say, it goes down to like 20 times and you hold it for 5 years. Um, if this is what plays out, it's not such a great investment, right? Well, it depends on what your view on the risk is. The reward is 10%. But if you think the risk, basically you have zero chance of or very low chance of losing any money, that could still be an attractive investment for you, right? So that's the other thing is just because the returns are higher doesn't make it a better investment because you have to compare um, the risk versus the reward, right? It's entirely possible that across all these investments, the best risk reward is this high yield savings account um, because it has uh, virtually no risk, and then all these other investments have a ton of risk, right? Um, and the concept of how to actually evaluate risk, that is a very long discussion that's going to take many videos to cover and is something that you spend an entire lifetime as an investor learning how to figure out but in the coming posts I'll also break down various frameworks and mental models just like this one to help you evaluate risk, and then eventually we'll get to a point where I can walk through an actual investment and layer in all the complexities of the real world. But I want you to, in this video, my hope for you is that you can just walk away with just this simple tool, just this simple framework, and slowly start to allow it to sink deeper and deeper into your mind. Um, this idea of returns and this idea of where are my returns coming from? Cash yield or growth or capital appreciation. Um, because remember, if it comes from capital appreciation, right? I'll give you an example, right? Like let's say there's a company that for the first 3 years of your investment, it does really well, right? It doesn't pay any dividends, it's a growth stock. Um, and it grows earnings at like 50% per year, right? For 3 years in a row. Uh, and remember, you're not getting any dividend, right? So the whatever you paid for the shares, that is the capital that's at risk in year one, in year two, in year three, right? And then in year three, the company, you know, there's new competition that comes in, and the business gets fundamentally impaired, right? I'm not just talking about the stock price going down, but I mean that the company's ability to generate cash flow becomes impaired permanently after year three, and uh, and let's say the earnings get cut in half, right? And the multiple also gets cut in half because the reduced expectations of the future. Because you haven't earned any cash yield while you wait, all of your capital is at risk the whole time, right? Now, if the same thing happens, except the company had paid out, um, a 10% dividend each of those 3 years, by year three, um, uh, some of your capital, you've gotten some of your capital back. So not the same amount of capital is at risk the whole time, right? So this is why value investors particularly love for their returns to come from cash yield, because as you wait, your principal at risk is getting de-risked, right, over time. And why they don't like growth investing so much, because your capital is always at risk. Now, the trade-off is that if you're invested in like a really wonderful business that doesn't get disrupted, it is better to have the company reinvested on your behalf because the company can reinvest in the business on a tax-free basis, and it doesn't leave you with money back in your account, which now you have to go find another investment. You see, it's like this is a concept we'll have to kind of dive into more deeply, but I just want to start to help you think through why it matters, like why we're doing all this. Why do we break it up into the cash yield and the growth? And this is one way to differentiate between value investors and growth investors. Value investors want their returns to come from yield and growth investors want their returns to come more from growth than yield, right? And it's the same in real estate and in stocks. Um, but that's it for this video. I hope this was helpful for you, and please leave any questions you have in the comments, and I will get back to you as soon as I can.